Conversations. We are back again to understand the difference between new age companies and new age companies. A new age company typically refers to a company that embraces innovative and progressive ideas, technologies, and practices in the operations and business model. On the other hand, a new edge company refers to a company that is at the forefront of industry advancements, cutting edge technologies, and business strategies. These companies are constantly pushing the boundaries of what's possible, leveraging the latest tools and techniques to stay ahead of the competition. So let's deep dive into this with the market expert, Ms. Meeta Shetty, fund manager at Tata Mutual Funds. Tata Mutual Fund is a part of prestigious Tata Group of companies on May 31st, 2022. Tata Mutual Fund Funds has had an AUM of 86,987.36 crores. Ms. Meeta has over 15 years of industry experience. Prior to joining Tata Asset Management, she has worked with Kotak Securities Limited, HDFC Security Limited, Asia Market Securities, and Dalal Brosha Stock Broking. Ms. Meeta is also managing funds like Tata Focused Equity Fund, Tata Digital India Fund, as well as India Pharma and HC Fund. Now, I'll be handing over the mic to Mr. Vikas Agrawal, who will in turn be handing over the mic to Ms. Meeta. Over to you, sir.
Uh, yeah, thank you, Pragya. Hello, Meeta. How are you?
Hi Vikas, I'm good. How are you?
Yeah, all well. So, thank you so much for accepting our request and coming on this conclave. This conclave is all about alternate investing and portfolio management services. But this topic, particularly chosen by us, based on the request from most of the investors, is that they're getting confused with new age company and new age company in the sense that you know you have a lot of confusion taking place. A lot of investors are making mistakes of investing in these new age businesses, and they've realized after their IPOs are out, their stocks are down by good 50, 60, 70%. So I thought who would be the better person than Meeta, herself. She's coming and talking to our investors and explaining the difference. Also, if you would like to talk anything else about, the way that you manage the funds, is all going to be yours. So floor is yours. Over to you. Thank you.
Sure, sure. So first of all, thank you so much, Vikas, for giving the opportunity and the platform to connect to such a large base of investors. And I think you're doing a great job. Congratulations to you and the entire AIF and PMS.com team. I think it's a very, very good step in the right direction. Coming to how I manage funds, so I've been managing funds since 2018 at Tata. And obviously, I mean, at a house level, we definitely have a philosophy of GARP, which is growth at reasonable price. And we try and stitch around our portfolio, which somewhere falls into this bracket. Now, this will include a lot of various kind of stocks or opportunities, which may fall into a special situation, which I think the previous speaker was just highlighting, or it could be just a pure, intern change in the kind of growth parameter for the company, and suddenly the growth and value fits into a very, very interesting kind of range. So it can be multiple legs of how GARP stocks are, or a GARP industry is. But the idea is that if it's a GARP stock or an industry, you generally not only end up making growth-led returns, but you also have some element of re-rating going into that. And that's where we end up generating alpha for our investors. So that's the broader philosophy. Apart of that, obviously, I try to see that we have a decent balance of, some steady compounders, some deep value also, but obviously having some edge of growth. So it's a healthy mix, which is why I think, which is what makes us believe that it gives you a steady, steadiness in a volatile market, but also gives you some return generating opportunities at the same time. So let's dive into the into the slides which I've made,
Yeah.
and which is why I'm here to talk on the new age and the
Right.
new age companies.
Yeah.
I think my slide is visible.
Uh, yeah. I'll just request Manvi to put up that. Yeah. Yeah.
Right,
Your
it's visible,
full,
right?
full view. Yeah. Slide view.
Okay, is that better?
Better. Over to you.
Okay. Great. So thank you, audience, for your time. And when Vikas reached out to me, and we were thinking about what we can talk around new age. Versus a new age. I thought that new age is something that has been the talk of the town for the last 3 years. Particularly during COVID, I think new age was a coined word, wherein anything which was perceived as new age, everybody wanted to latch on to it and ensure that they are there for this new age companies which were promising very strong growth into the future. And everybody, at whatever price it was available, everybody wanted to be a part of this journey. So let's look at some of the interesting IPOs which came in around 2021. This was a time when new age was the hot selling cake, or so. So you can see that yes, that was a time when everybody wanted to participate. But today, around almost 2-3 years down the line, we can see that most of the prominent names. So I've not made this list very exhaustive, just listed out some very very prominent names which came out around that time. And you can see that the performance of most of the stocks today, as of just recent dates, how have they performed? And clearly, one thing is very clearly seen in most of the names is that there has been a massive rundown on the valuations of these set of companies. There's been a massive wealth erosion which has happened, and the question then comes to us that what has suddenly gone so wrong? I mean, where have the industry gone wrong? Is it not growing as much? Is there now risk perceived? So a lot of things have changed. But one thing was clear, that now the investors are not willing to take part in opportunities or stocks where there is a lack of visibility on profits. If you don't show profits, there is no value ascribed to higher value ascribed to that company. Second was obviously the interest rate increase which happened, and in a higher interest rate scenario, nobody wanted to be sided with companies which are high growth companies, because there is a clear linkage between how interest rates impact the valuations of high growth companies. So clearly that was the second reason why we saw what we saw. And third was obviously there was a complete risk aversion, right? That frenzy of new age, everybody just wanted to part themselves away with that. A lot of investors probably would have also booked huge losses. Some are sitting on huge losses. So clearly there is a shift in what was perceived earlier versus what is perceived now. Some bit because of the interest rate, but some bit also because of now profitability is at the core of the argument today. So interesting question comes to mind is then how should one value these companies? Okay, we were there in 2021. Everybody wanted to give whatever value is available, or whatever the best of the value one can give to them. But now, after a drawdown of 70-80%, there is a question coming to us, and I'm sure in everyone's mind, that are we valuing them right, or did we value them right way back in 21? So before I get into how do you value them, I think there are some very basic things which I think we as fund managers and analysts definitely want our boxes to be ticked. Now, does not only ascribe to a new age company. For that matter, it actually implies to everything which is there in the market, whether new age or an older non-profitable company. So let's look at these 3 points first. Inflection point. So when I say an inflection point, it possibly means that either there is a complete turning point which is happening into that industry, or there is a significant development which has happened and which is generally now leading to a very different kind of growth horizon. Or in most of the cases, when we say inflection point, we're basically talking about a mass adoption which is suddenly now come to picture, and it's suddenly getting used by each and every possible customer who can use it. So that is very critical when we are particularly looking at any of the new age companies. Second important point is the strong growth runway. Now, thankfully, we are all living into a country which is one of the fastest growing, developing economy, and it is probably likely to be so for the next couple of years or probably a decade. And thankfully, because the economy is doing so well, there are so many legs of pockets where there is a very strong growth runway. And when we particularly talk about the new age companies, because these new age companies are changing the way we are behaving as a customer, the way we are purchasing things, the way we are ordering things, the way we are transacting, it's changing every possible way the touch points have been for us as customers. And clearly that is leading to a good strong runway growth for these companies possibly going into the future. First, the economy is doing well, and second, because these are very nascent developments which have happened and the mass adoption is still to happen, there's clearly a growth runway which is visible. So that is the second thing which is very, very important for us investors, you as investors, to understand that whether there is a strong runway of growth. And third, and the most critical, is that is there a path to profitability? So I understand that immediately in the initial years the companies may not be profitable, but is there a path to profitability? Is there some horizon, or at least some certainty, where we can say that after x number of years these companies will start making profit? And is there a roadmap to that profitability? Because ultimately it's all about how much money have you put into that business and how much have you earned out of that business. Unless the businesses don't start earning money, it's very difficult for us as investors to start making profit on that entity, or that enterprise. So clearly these are the three very critical points. If I have to just deep dive into all the three of them, the inflection points. So let's look at this interesting examples of the vehicle ownership across some important geographies. And the idea to put this data here is not to comment anything on the auto sector. I think this data clearly tells you that how the auto sector probably might behave. But this is also to point out that when the inflection points in any industry is hit, the growth rates post that inflection point is clearly massive, and it's far far superior to what it has been in the last few years. So you can see that Japan, Korea, where they were in say 1949 or 1950 to what Japan was in 62, and how the per thousand people ownership of car moved from just a 30 odd number to as high as almost 600. Similarly, for a Korea market, I mean, it moved from just about 2030 to almost 400 in a matter of point. And you can see that the inflection point to the journey of reaching that massive number of 500 or a 400 has where the most of the money would have been made for the investors would have invested into those companies or industries. Even for that matter, India, I mean, India, we have the third largest network of roads globally, and our ownership levels are still fairly low. I mean, this data points out to almost 40, 50 cars in 2017. Today, the number has clearly gone to closer to 200. But if you look at the number of households which are owning cars in India, as of December 22, I think the data points out to just about 7.5%. So 7.5% of households are owning car in India, and that's about it. So clearly, inflection points make a huge difference for any industry. And when we are evaluating the new age companies, one has to see whether we are closer to that inflection point. Because if we are not very closer to that, then probably there is a runway of growth, but not as great as it can be post that inflection point happens. So inflection point becomes a very critical factor when we are looking at these new age companies. Another important thing to watch out for in the inflection point is particularly perceived to India as a country. I mean, we all use mobile phones. We all have internet connections now, thanks to what we saw in the mobile operator industry in 2017. Most of the hands in India, which are in the age group of 20 to say 70, we all have some access to internet today. But when you look at the online shoppers data, barely about 15 odd crore people in 2020 were online shoppers versus a good 70 odd crore or 65, 70 odd crore a population which had access to internet in some way. This number, as per Redseers, is expected to go to somewhere close to 15, is going to 35, 40 crores. And that's almost a massive 2.5 to 3 times jumps that we are talking about. And if that is what is going to unfold, and imagine by 2030 where this number can probably look like, uh, just 50% penetration will also mean that we are talking about 70 odd crore people using online shopping versus just 15 odd crore people using in 2020. So is this an inflection point? Probably yes, I think. And this will go on to benefit most of these new age companies, no matter what vertical they are in. Obviously, there has to be a good runway of growth for that, which we'll cover in the next slide. But particularly, it tells you that there is definitely a room for inflection for these new age companies when it comes to India as a country. Second important point which I was highlighting was strong runway of growth. Now, this was a very interesting data which I thought that makes a lot of sense to add here and highlight. Now, this example I've taken is of the share of out of home food. So basically, the food that we have in the restaurants or outside. And second data point is of the how much is online food delivery as percentage of that total. You can see that in India, we are hardly eating out of home. India, we always, this is a country where we believe that outside food is not very hygiene, and we generally avoid eating so much outside. We prefer the home cooked food. And look at the other countries. I mean, in China or South Korea or USA, the share of out of home food is massively higher than what we are. They're probably 5 6 times higher than where we are. One reason for that is clearly that the women participation in workforce is far higher in those countries. So if I have to share some data points, China probably is at about 70 odd percent women in the workforce, whereas India we are barely 30% or so. So clearly that is also one of the reason why, I mean, women are still into the conventional duties of taking care of the home and cooking, whereas that probably is not very feasible for someone like China, where the women participation is almost 70%. So clearly, these are the things which are changing in India as well. And I think clearly a decade later, this number will look far, far better as far as the out of home food consumption is concerned. So that tells you that probably we are at a strong runway for the restaurant businesses as well. Coming to the online food delivery, again, here the penetration for India is about less than 10%. Globally, it has been at about 20 odd percent. So, there also, once we have more out of food consumption, we see the online food portals also seeing more participation happening from these customers for online delivery. So, clearly, that tells you that this industry is probably sitting on the verge of a strong growth runway. Now, this is just one example, right? But if I look at insurance, if I look at cars, when we buy or sell online, or for that matter, any other marketplace, which is B2B or a B2C, I think that what we need to understand is that first, is there an inflection point in the industry? Second, is there a strong growth runway? Because once this inflection touches, you also have to have a strong runway of growth. I mean, if we are talking about a product which may everybody may not want to own or everybody may not want to use, then your growth runway may be curtailed at some point in time, and we probably will peak out much sooner than what we saw in the previous charts of a car ownership. So this is a very second important point to keep in mind when we are looking at these new age kind of companies. Third, and I think this is the most important and the critical aspect of looking at new age companies. I think the dilemma which most of these new age company promoters or startup guys have is that should you look at profitability or should you look at scale? Now, when you're talking about profitability or scale, I think that everybody wants to grow faster, and the faster you grow, you probably are reaching a much larger scale, much larger audience, much larger number of customers, And then you are also thinking that the bigger you grow, profitability will follow. But then there has to be a point where these promoters, or at least as investors, we understand that how fast does these managements plan to grow. Let's look an example of WeWork, right? We work in about 2018 had around 400 odd locations. They were growing at a breakneck speed, and they were just looking at growth at all parameters. They went from 400 to 800 or 750 odd just in a year's time. Even on their membership, they were massively growing in around 2018-19, or for that matter of that 5-6 years from 2015 onwards. And look at the valuations. I mean, initially the investors were rewarding them. The valuations around 2018-19 for that company was pegged at somewhere close to $50 billion. But once there was a realization that these high growths are not following up with any profitability or a roadmap of profitability, that 50 odd billion dollar was valued at just about $9 billion in 2021. Just in 2 years, there was a massive value erosion. And even today, if you look at the valuation or the market cap for that company is less than $1 billion. So from 49 to just about $1 billion. And profitability was one of the biggest reason why what we've seen, what in terms of how the stock has behaved or how the market cap has eroded.
Yeah.
So yes, you want to grow fast, but then you also have to have some horizon as to how fast do you want to grow, and how you are looking at that growth going into the future, whether you are only looking at growth or are you also looking at profitability. Second important thing to look here is that is it a winner takes it all market? So there will be industries, there will be segments where if you are growing very fast and if you are into a monopolistic kind of scenario, then definitely you are the only one, and then your profitability is completely up to you. You can just swing the profitability the way you want. So I think if I have to give an example, maybe a Google or a Walmart probably falls into that category. So if is it a winner take all market? Probably for Google and for a Walmart, yes, because they kept growing, they kept spending, and then they are into more or less a monopoly market, and profitability definitely will follow at some point in time. So that is another important question. But if I look at Uber's case, Uber always thought that it's a winner takes all market, and we have seen that only growing has not helped, and they've actually not done well in terms of the investors' money. So the second important point is it a winner takes all market? Third is that is there a target market share which gives you some visibility on profitability? So if your question on is there a target market share is answered, so if you know that particular management or a particular industry is eyeing that they want to grow to, say, an online food delivery is eyeing that they want to become a 30% of the restaurant market, or if a particular company is believing that they want to become 60% of the online food delivery market, or say insurance market, at least then as an investor you are sure that at some point you will achieve that number, and then you will go back to your profitability. You will assume that that company will start turning profitability because they will not be burning cash to grow. Most of these companies, the problem is that because to grow fast, they're consistently burning cash. They're acquiring customers. The value to acquire customer is pulling down their profitability, and that's kind of putting into them a tailspin where profits are just not following, and they're just focusing on the growth. So that is the most important thing, that how that market share is perceived. Where is the target market share for these companies, or is there even a target market share for that company?
So, Meeta, sorry to interrupt. So,
Yeah.
we are running short of time. So, anything else that you
Sure.
want to? Yeah.
Can I just quickly run through my following slides, if that
Uh,
is okay?
yeah. So, unfortunately, there was some technical delay, from our
Okay,
end.
okay. So
Running
let
short
me
of
just go to last slide, and then maybe.
time.
So these were few examples I gave that how Amazon initial years did not make profit after listing, but then it turned profitable. This is the profit margin. This is the profit, and this is the 100 times return which it has made for the stocks. Uber again, as I was saying, that has bleeded. but then stock also has not gone anywhere, so investors have not been able to gain a lot of it. uh, DCF, I think, is critical for these companies. I think DCF is very critical. You cannot value them on price to earning EV EBITDA, but DCF model is very, very critical aspect for this, and that's how we value these companies. Last slide. Are these movie companies moving to an edge? Since the topic was about new age and new age, I thought I'll cover this. So I think new age would mean any kind of mode that a company is creating or industry is creating. So economies of scale, probably we are talking about a Walmart kind of company here. Network effect would be anything like a Visa or a MasterCard. Goodwill, customer goodwill would be something like a Disney. I mean, it's created a customer goodwill where nobody wants to now look at any other option there. High customer switching cost would be probably like a Microsoft Outlook or an Outlook as a whole. I mean, there are options, but do we want to switch because the customer cost, switching cost is much higher? So these are few of the edges which companies can probably, reach over a period, and we have to see whether these new age companies are reaching to any of these new age kind of levels. So I think, yeah, I think because we are short of time, I can't dwell into each of these companies as planned. But yeah, anything over to you, Vikas.
Yeah, yeah. Thank you so much for lovely presentation. We got a lot of insights about what is the difference, and as I said, there are a lot of investors who make mistakes investing in companies, during their IPO times, and then, I mean, I don't want to take the examples, but I'm saying that after that they realize that they made big mistakes. So, your
Right.
presentation certainly help all of them, and you're doing fantastically well on the fund side as well, managing the fund very, very efficiently. So, best wishes to you from our side. Thank
Thank
you
you.
so much.
Thank you, Vikas. Thanks.
Thank you. Thanks for joining.